Now, my first guest says that we are seeing classic rotation, not a correction, when I'm bringing out Bahnsen Group Managing Director Dave Bahnsen. Dave, thanks for joining us. So BCA Research put this out. You know, they put out some really good work, and they're saying for those folks out there who are saying, okay, there's sort of a rotation going on, that if you look back in 2000, as tech names on the green were crashing, the other names, right, the non-tech names, are sort of sideways, even moving higher. And that maybe we're in a scenario like this, like, okay, everything's not crashing, but don't think that money's going to leave tech and simply go to the 493.
Yeah, I mean, the other example is 2022. That's a lot more recent history, where you did have the S&P down 19, but you had dividend growth names up 5%. You had large cap value closer to zero than down 20. So rotations are just as common as full-blown bear markets. When I say I think we're seeing early stages of rotation, it's more descriptive. That is what we saw in the last 4, 5, 6 weeks. Whether or not it sustains into 2026 is a bigger question. We're definitely overdue for it. I don't have any doubt in my mind it's going to happen. Whether or not this is the moment, I wouldn't dare to speculate.
But is there a difference, a distinct difference between, okay, rotation meaning new leadership, but also a certain number of losers, or just a broad rally? You know, for a while now, we've seen names above the 20-day moving average, you know, up to 75%. Could we have a scenario where the same tide lifts all ships?
I don't think so at 23 times forward earnings. It's just very difficult to get that. It's not impossible.
Right.
Expensive markets can get more expensive. This has been in that range for 2-3 years. So people that want to make an argument that just because it's expensive doesn't mean it's going to drop, that's fine. But it makes it harder to get a big rally, which is, I think, your question. Right. To get a 15-20% rally on top of 3 years in a row of robust, not only double-digit earnings growth, but multiple expansion, it's just almost unprecedented.
Right. I mean, this year, I think a lot of people will be shocked at how big of a role earnings have played into this as opposed to multiple. But here's the thing. So you've got value versus growth. And I could have gone much further out with this chart. And we've had times where it looks like, okay, it was value's turn. And of course, these rallies against growth petered out.
Right.
The question is, why now? I mean, why would this be the moment now for value to sort of outperform?
There wouldn't be any reason I can come up with. I wouldn't make the argument that value is due to outperform growth at any given point in time. I can only just tell people that historically, on 10-year cycles, it always does, that there's generally that big rotation. If we want to go back to that 2000 example of when tech was so far ahead of itself, fell dramatically. I'm writing a dividendcafe.com for tomorrow, studying the last 25 years of this really interesting century we're in.
Right.
And you go back to where things were. The NASDAQ dropped 78% peak to trough. It didn't make a new high for 16 years. That was extremely stretched valuations. The S&P then, though, was trading at 29 times earnings, came all the way down to 15. Value in that 10 years compounded 7% a year. Growth compounded negative 7% a year. You get those types of decades, it's hard to know where we're going to be.
So let's talk about the sectors that you like here. You like energy, healthcare, and consumer staples at this point.
Yeah, and the thing I would say whenever I talk about sector I like is those where the names are that we like. We're bottom-up investors, but we have names in energy, healthcare staples that we do like on a valuation basis, on a dividend growth basis, and so forth. And obviously, it's just had a heck of a run, especially on the healthcare side these last 6 weeks. Consumer staples is still very out of favor. It's one of the only areas anyone can look in the market, and maybe energy as well, and say, oh, there's some underpriced stuff.
I mean, earlier today, they were the only two sectors that were down.
That's
Everything else was up, to your point. Hey, I want to get to the specific stocks. First, I got to ask you about Blue Owl, of course.
Yeah.
It's a name you've talked about in the past. Made news yesterday, big time.
Yeah.
And by the way, today, the ambulance chasers are out there and all the lawsuits against Blue Owl. Of course, they decided not to back this one particular data center in Michigan. You know, the status on Blue Owl and just private equity / credit.
Yeah, there's a lot of misunderstanding on the thing with Blue Owl, and some of the stuff on the screen has to do with the BDC they have, and they wanted to merge a public and a private one. It's one of the investments Blue Owl manages, not the general partner
Did they
itself.
decide not to do that?
And they did decide at this time not to go forward, and I don't really have a dog in that hunt either way. But Blue Owl is basically an asset manager that's in real estate, private credit, private equity, infrastructure, good asset managers. They merged together two very capable firms. And I think that they're going to have a hard time dealing with some of the cyclical challenges they have. That there's a lot that they're going to have to deal with because they have a lot of PIK exposure in their private equity portfolio. But in terms of their fee-based business, where they are valuation-wise, a 6% dividend yield, longer term play, I really believe investors are going to be rewarded down the line. The data center thing is fascinating because you're finally getting some asset managers saying we're not desperate to do this deal. This Oracle deal doesn't make sense to us. We're going to walk away.
Yeah.
There's other equity people that are going to walk away from some of these deals.
Before I let you go, Federal Reserve battle, it's a horse race. I guess now Hassett is ahead at 53, Warsh is 58, Waller now, who just had an interview at 12, and there's still some folks out there hoping maybe Bahnsen gets a job.
Yeah, well, President Trump is one of those, I think. I think he would still take a Treasury Secretary that double dipped, but I don't think that's going to happen. The betting odds are really having to go off of lack of information.
Right.
They can speculate based on...
Who would you like to see, then?
Kevin Warsh, no question. Hands down who I'd most like to see. He was an economist at Morgan Stanley when I was there for many years. I think very highly of him. I've known Kevin a long time. But he has a history of being willing to be independent. Of going out, he was against QE, asking questions on some of these things in the past. And I think that he also understands that the Fed has been too tight too long. He would accommodate, but I don't think he'd do it for the wrong reason. Right. And I worry some of the people would do the right thing for the wrong reason. That troubles me, Charles.
Yeah. Hey, by the way, we're out of time, but I want to let the audience know, both watching and listening, Blackstone, BX, Vail Resorts, Mountain, always loved the symbol there, MTN.
Yeah.
Love the way he's acting, and Pepsi, PEP. Great stuff, my man.
Good to see you, my friend.
See you soon.
All right.
Thank you.